welcome to another session today. I'm excited to talk with you today about tax advantaged accounts. And I love this topic so much because it is a way for you as a person to make your money work harder for you and smarter for you, because the key word here is you want your money to work smartly for you. So one of the first ones I want to talk about is obviously retirement accounts. And retirement accounts can be tax advantaged depending on the type of retirement account that you choose. So for example, someone who is looking to put money away for retirement, meaning after they decide that they no longer want to continue working, then you would want to put it in either a traditional retirement account or a Roth retirement account, also known as a Roth IRA or a traditional IRA. The major differences with these two is with the Roth IRA, you are making contributions that are taxed, but when it's time for you to take the funds out during retirement or during a qualified event, the taxes, you don't pay any taxes on them. On the other hand, with the traditional IRAs, you are going to be paying taxes on the withdrawals when it comes to time for you to take them. For example, when you reach the age to take a required minimum distribution, which is usually in your 70s, I believe it's 72 or 73 for this tax year. Or if you have a qualified event, for example, you're a first-time home buyer and you need to take money, you need to pull funds from your IRA so you can make a down payment. It's very important to note that if you take out your withdrawals when it's a non-qualifying event, you may be subject to taxes. Now, I want to backtrack a little bit and say with the IRA, you can start taking withdrawals at 59 and a half. You do not have to wait until you're 73 to take out withdrawals. The 73 age stipulation is really for if you have never taken out anything from your traditional IRA. You will have to start, that's when you are required to take your minimum distribution. And it's usually calculated based on your life expectancy. Now, I say it's tax advantaged because you aren't paying taxes on the traditional when you are putting money into the traditional IRA. You're only paying taxes on the amount that you withdraw at the time that you take the withdrawal. Assuming that you're taking the funds out either for a qualified event or you're 59 and a half, or you're taking a required minimum distribution. Anything short of that, you may be subject to penalties. So you really want to make sure that you are taking out the funds within those qualified events. And then for the Roth, the reason it's tax advantaged is that when you are definitely going to make, you're going to have to pay taxes when you're contributing towards your IRA, but when it comes time for you to take out the withdrawals, then you're definitely not paying any taxes at all. Now, there's a little bit of a fine line with the Roth because sometimes you are able to take out the principal, so that would be the amount that you put in your first year of contribution out 5 years from the time you contributed. However, and that is if that principal amount has been in there for at least 5 years. Then you can start taking out the withdrawals after that. However, you also have to watch out for making sure that they are qualified events that you are taking out your funds from the Roth, because you don't want to pay penalties. So you want to double check and make sure that you're not violating the terms of when you are allowed to take out funds from your Roth. The reason people love it a lot is, say for example, you're young, like you're in your mid 20s or early 30s, you have a whole career there waiting for you. So it's very, very likely that your salary is going to increase throughout the year. So, well, throughout your lifetime, sorry, not throughout the year. So you have the option and the opportunity to earn more as you grow older or as you progress in your career. What this really means is that if you set it up with a Roth, then you're probably going to save more in taxes up front than you would if you set up a traditional. Why? Because when it comes time for you to take out those funds as you would like to, you will not be paying taxes on them. And in the event that you are in a higher income tax bracket, meaning that your salary or your earning potential has been increasing consistently over the years, then you're obviously not going to be paying higher taxes than you would if you had opened up a traditional and then throughout the years your salary had increased, and then now you have to pay taxes out of a higher tax bracket. So that's really the major benefit of the Roth for younger people. And I honestly encourage younger people to do this. I do it too, which is I do have a Roth where I'm putting aside funds because I'm anticipating that as I grow older, I'm going to increase my earning potential. So I really want to save on the amount of taxes I'm going to be paying in the future by paying for them now. Now, if you are older and you have like a fixed income, then the Roth may not be advantageous to you because there may not be a lot of room for growth in terms of your earning potential. So it really will not make a difference for you tax-wise if you made a contribution to a Roth and paid prior and paid the taxes with the contribution, or if you took out the funds from a traditional and paid the taxes on the withdrawal side. It makes more sense to do it the traditional way just because it's the more common IRA for like the older community. But people who are younger, I really encourage you to explore the Roth option because of the advantages that I've listed. If you are confident in your ability to grow your career and grow your earning potential over the years, and I would definitely encourage you to look into the Roth as an option for your retirement plan as opposed to just putting it in a traditional. Because remember, with a traditional, if you happen to be in a higher tax bracket by the time you're 63 or whatever year you retire, then you're going to have to, you may pay higher taxes than if you were paying the taxes now when you're younger and you're contributing to your Roth. Does that make sense? All right. So then the other one that I really, really love is the HSA. And HSA stands for Health Savings Account. And this is a very, very good account to have because it's triple taxed advantage. And what that means is that you're saving taxes in three ways. The first way you're saving is you are getting a tax deferral treatment for any contributions that you make towards your health savings account. The second way is that any income or any interest that is growing or compounding from your principal is tax deferred. So it's growing tax deferred. You don't have to pay any taxes on it when tax season comes rolling around the next year, because it's treated that way, that it's tax deferred to a later time. Let's say you decide to take out the funds sometime in the future. The third way it's tax advantage is that any withdrawals that you make for expenses, medical expenses, you don't have to pay taxes on them. So say, for example, you went to see the doctor and you had this bill for, let's say, $300, and you have about $2,000 in your HSA account. You can take out funds from your HSA account and you can direct those funds to pay your medical expenses. Now, there's a caveat here. You can only You will not be paying taxes on any medical expenses, and they have to be really medical expenses that are, what's the word I'm looking for? They cannot be like, let's say a good example is you can't, for example, go to Walmart and buy like toilet paper, for example, and say you're going to use that, you're going to allocate that for medical expenses, because it really isn't. If you are going to buy over-the-counter drugs, I would definitely recommend going to like a pharmacy so that you have receipts in any event that the IRS decides to audit you. You can show proof that you used the funds from your HSA appropriately and you did not misuse them, because if you use these funds for anything that is not medically related, then that means that you're going to be fined a hefty penalty. So you don't want to do that. You just want to make sure that your expenses are really geared towards the medical expenses of things. So anything from doctor's appointments, over-the-counter prescriptions that you need, if you get them from a pharmacy, which I really recommend, that's what you do, as opposed to going to our convenience store and buying them there. Also prescription drugs, those qualify as well. And if you go to the IRS website, you will see how they explain what medical expenses qualify for this type of HSA withdrawal. Now, another interesting thing about the HSA is that when you reach time of retirement, you can actually roll your HSA into you can do a conversion of your HSA into a retirement account. So you can roll it into either a Roth if you have one, or a traditional IRA. So in that way, you are saving money. You're not only saving money, but you're also saving on taxes, and you're also growing your net worth. And you know, that's a key thing about me, is I really want to help you build financial independence and your net worth and your wealth. And these are some of the ways that you do it, is by finding accounts that work for you and making your money work smart for you. Okay, that's all I had for today on tax advantaged accounts. I know I have given you a lot of information. If you have any questions about how to set up an HSA, how to tell whether a Roth or a traditional is the right one for me, please let me know. You can reach out to me or send me a message in the chat below. I am sure I have a contact on my YouTube channel. And you can also visit my website at mariahorne.com. And until next time, I hope to see you again, and I wish you a great rest of the month, because we're going into March pretty soon. All right, bye for now.